Hi everybody, welcome back. I hope you're having a great week. Before we jump into it, consider subscribing so you won't miss next week's video. So what are we talking about today? We are talking about what does a write-off mean anyway? Anytime you hear somebody on social media or the news talk about deductions, they're always talking about write-offs. Write this off, write that off. So we're going to talk about that today. So first things first, it's important to understand that in calculating your tax, we start with your income, we subtract your deductions to come up with your taxable income. That taxable income is what your tax rate is applied to and how your tax is calculated. So deductions are that piece above taxable income. So every dollar that we bring down your taxable income helps bring down your tax. It doesn't bring down your tax dollar for dollar. So what are some examples of some deductions? If you are an individual, if this is your personal tax return, the number one best thing you can do to bring down your taxable income is the stuff you can do at work. So if they offer you pre-tax options, it might be your 401k, they might offer flexible spending or health savings accounts, pre-tax health insurance, dependent care benefits. If those things make sense for you, they can help bring down your taxable income. You don't see that on the tax return because it happens in your W-2, but they do bring down your taxable income. If you're eligible, you could potentially contribute to an IRA retirement account to help bring down your taxable income. And with those options, it is important to have the conversation around whether a traditional pre-tax contribution makes the most sense for you or whether the non-deductible Roth contribution makes the most sense to you. But we have another video on that. I can link to that. If you have rental real estate that is running at a loss, it's possible that you'll be able to take a deduction for that loss to bring down your taxable income. Also, losses from investment sales may also be able to bring down your taxable income, though that's limited. The main deductions that we tend to talk about for personal returns have to do with your mortgage interest and your property taxes and your donations and your medical expenses. Those are your itemized deductions. They're only going to help you if your itemized deductions are more than your standard, and we did another video on that as well. So I'm going to link to that as well rather than digging into it here. If you have a business, you're able to deduct the ordinary and necessary expenses of performing that business, of trying to bring in income with that business. It doesn't mean necessary in the way that you tend to think of necessary, but if another reasonable business owner in your position, in your field, would find that a reasonable expense, generally it's going to be deductible. Things like your office space, your subscriptions, your advertising, legal and accounting fees, your automobile expenses, equipment, all of those things are just deductible. They bring down your business income before your tax is calculated. If your business has a loss, it'll bring down your other income. Brings up a whole nother topic of whether it's really a business or if it's a hobby. But if it's really a business and it's running at a loss, it will bring down your taxable income. These expenses reduce your taxable income. They also reduce your self-employment tax. So that makes these business deductions more impactful than maybe a charitable donation would be. One thing to note, because it's going around social media quite a lot, is that you can't create an LLC, pay your personal expenses with it, and deduct those personal expenses. Those personal expenses are going to be personal, whether you're paying for them from your personal checking account or from an LLC account or from a business account. A personal expense is not deductible. So to circle back, because these deductions are bringing down your taxable income, they don't bring down your tax dollar for dollar. So if you put $1,000 into an IRA when you were eligible, you may save $200 to $300 in tax. Buying an $80,000 vehicle exclusively for your business may, over multiple years, not all at once, save you $30,000 in tax. And the thing I want to come back to with this is that it means that you're spending $1 to save 20 to 30 cents in tax. That may make sense in some instances. For that vehicle, you might need it for work. It might need to be an exclusive for business vehicle. And you would have spent it anyway, whether you had the deduction or not. That's fine. But I would never say to go spend money just for the tax deduction. I would rather have, 70 cents in my pocket than, and I've given the IRS the other 30, than to spend the whole dollar. So one other thing just to bring up is that in addition to deductions or write-offs, there are also credits. And credits do reduce your tax dollar for dollar. But there are limitations. Some of them are not refundable. So this is just generic. Please consult your tax pro if any of these apply to you and you want to understand how they impact your tax return. But there's a credit for solar energy projects, for electric vehicles. There's the child tax credit, child care credit, earned income credit. So a bunch of credits around kids. There's an education credit. Those credits do reduce your tax dollar for dollar. So they do have more of an impact. But really, if you're looking for, I want to put my money somewhere and I want to take a tax deduction for it, your deductions for the most part are not going to be dollar for dollar. Things like retirement plan contributions and such are usually the go-to places to put those dollars. But again, please consult your tax pro. Have those conversations. That's what we're here for. Are there any questions? Anything I missed? Anything that was unclear? Anything I should tackle next week? Definitely let me know. Again, subscribe and have a fantastic day. See you next week.